Right now, millions of Americans are waking up, checking their bank accounts, and assuming their Social Security deposit is going to look the same as it did last month. But if you are collecting benefits today, or if you are planning to retire sometime in the next 12 to 24 months, there is something happening in 2026 that the mainstream financial media has barely touched, and it has the potential to shrink your monthly check in ways most retirees are completely unprepared for. This is not a scare tactic. This is not speculation. The numbers are already baked into the system, and the people who ignore this information are the ones who will feel it the hardest when their deposit hits, and it is smaller than they budgeted for. Here is the part that makes this even more unsettling. There is one protection strategy that a significant portion of retirees either do not know about or keep pushing off to deal with later. And by the time they finally pay attention, hundreds, sometimes thousands, of dollars have already quietly slipped out of their annual income. So stay with this all the way through, because the strategy we are going to walk through near the end of this could genuinely change how you plan your retirement finances going forward. Let us start with what is actually happening inside the Social Security system right now, because the foundation of this entire issue goes back to something called the COLA, the cost of living adjustment. Most retirees have come to rely on the COLA as a kind of annual raise, a built-in protection against inflation. And for the past few years, those adjustments were substantial. In 2022, recipients got an 8.7% increase, the largest in roughly 4 decades. In 2023, it was 3.2%. In 2024, it came down to 2.5%. The trend is moving in one direction, and early projections for 2026 are pointing toward an adjustment somewhere in the range of 2.2 to 2.6%, modest at best. On paper, that still sounds like a raise. But here is where the trap begins to spring. The COLA does not exist in a vacuum. It does not simply add money to your check and walk away. Every dollar that gets added through a cost of living adjustment has the potential to trigger a chain reaction across 3 different systems simultaneously: Medicare premiums, federal income taxes on benefits, and earnings-based withholding rules. And in 2026, all 3 of those systems are shifting in ways that are going to catch a large number of retirees completely off guard. Start with Medicare Part B. This is the piece that most retirees either forget about or dramatically underestimate. Medicare Part B premiums are deducted directly from your Social Security payment before the money ever reaches your bank account. You do not write a check. You do not transfer funds. The deduction happens automatically, and every year the premium has the potential to increase. In 2025, the standard Medicare Part B premium sits at $185 per month. Projections for 2026, based on current Medicare trustee reports and healthcare cost trends, suggest that premium is likely to rise again. Even a $10 to $15 monthly increase wipes out a substantial chunk of whatever COLA gain you just received. For a retiree receiving around $2,800 to $2,100 per month, a COLA of 2.4% adds roughly $43 to $50 to their gross benefit. If Medicare Part B goes up by $12, they have already surrendered about a quarter of that gain before they see a single dollar. And that is before we get to taxes. Now here is where it gets more complicated and frankly more frustrating. Federal income taxation on Social Security benefits is one of the most misunderstood aspects of the entire retirement income system. A lot of retirees believe their Social Security is tax-free. Some of it may be, but for a significant and growing number of beneficiaries, up to 85% of their Social Security income is subject to federal income tax. The thresholds that determine how much of your benefit gets taxed have not been adjusted for inflation in decades. The combined income threshold that triggers taxation, which factors in your adjusted gross income, your non-taxable interest, and half of your Social Security benefit, has stayed essentially frozen since the 1980s. That means every year, as benefits rise even slightly due to COLA, more and more retirees cross those thresholds and find themselves owing taxes on income they were not taxing before. This is what policy experts sometimes call bracket creep, and it is a very real and very quiet way that Social Security recipients lose purchasing power year after year without anyone making an announcement about it. For a retiree with other income sources, a pension, part-time work, retirement account withdrawals, rental income, crossing the $34,000 threshold as an individual or $44,000 as a married couple means that up to 85% of their Social Security benefit becomes taxable. If your combined income is just a few $100s over that line, your tax bill can jump considerably. And here is the painful irony. The COLA that was supposed to protect you from inflation is the exact mechanism that pushed you over the threshold in the first place. The system giveth, and then the system quietly taketh away. But we are not done yet, because there is a third layer to this, and it specifically hits people who are collecting Social Security before they reach full retirement age while still earning income from work. The Social Security earnings test is a rule that says if you have not yet reached your full retirement age and you earn above a certain threshold, the SSA will withhold a portion of your benefits. In 2025, that threshold is $22,320 per year. For every $2 you earn above that limit, $1 of your Social Security benefit is withheld. That threshold does adjust slightly each year, but so do wages. Anyone who retired early, took benefits at 62 or 63, and is still doing part-time consulting, freelancing, or any form of paid work needs to be running the math on this right now, because many are unknowingly triggering withholding they did not plan for, and their monthly deposit reflects it. Think about what this means in practice. A retiree who budgeted based on a $2,100 monthly Social Security payment could realistically end up receiving something closer to $1,850 to $1,950 once Medicare premiums come out, once taxes are factored into their quarterly estimated payments, and once any withholding kicks in due to part-time income. That is a gap of $150 to $250 per month. Over a full year, that is anywhere from $1,800 to $3,000 in income that simply does not materialize. For someone on a fixed retirement budget, that is not a rounding error. That is the difference between financial stability and quietly drawing down savings faster than planned. This is also the moment where people start making reactive financial decisions. They pull more from their IRA to cover the gap. That withdrawal increases their taxable income, which means next year, even more of their Social Security benefit is subject to tax. It becomes a cycle, not a dramatic one, not the kind that shows up as a crisis in the news, but a slow, compounding erosion of retirement income that builds year after year if it is never addressed. And the reason so many retirees fall into this cycle is simple. They checked their benefit amount once, they set their budget once, and they never revisited the calculation as the rules around them quietly shifted. So let us talk about what you can actually do, because this is not a situation where you are powerless. There are specific, practical steps you can take right now that can protect your income and put you in a far better position heading into 2026 and beyond. The first and most foundational step is to log into your My Social Security account at ssa.gov and pull your current benefit statement. Do this today, not next month. Review exactly what your gross benefit is, what is being deducted for Medicare, and what your net deposit actually looks like. A surprising number of retirees cannot immediately answer the question of how much is being withheld from their check each month. You cannot plan around a number you do not know precisely. The second step is to run what is called a combined income calculation before the end of this calendar year. Add up your adjusted gross income, any non-taxable interest you receive, and exactly half of your projected annual Social Security benefit. If that number is approaching or above $25,000 for a single filer or $32,000 for a married couple, you are entering the territory where your benefits start being taxed. If you are above $34,000 or $44,000 respectively, up to 85% of your benefit is taxable. Knowing which tier you are in allows you to make decisions about Roth conversions, about the timing of IRA withdrawals, about whether strategic income shifting makes sense for your situation. The third step involves Medicare specifically. Open enrollment for Medicare Advantage and Part D runs from October 15th through December 7th each year. Most retirees pick a plan once and never look at it again, but premiums, formularies, and coverage structures change annually. A plan that was optimal 3 years ago may now be costing you significantly more than a comparable alternative. Review your options every single year during open enrollment. This is not a complicated process. Medicare's official plan finder at medicare.gov lets you compare options side by side, and the savings can be meaningful. Fourth, if you are between 62 and your full retirement age and you are still working in any capacity, check the current earnings test threshold the moment you receive any income above what you expected. Do not wait until tax season to discover that the SSA withheld 2 months of benefits because your freelance income crossed the limit. The SSA will eventually return withheld amounts in the form of a higher benefit once you reach full retirement age. But in the short term, the cash flow impact can be severe for retirees who are living close to their monthly budget. Fifth, and this is perhaps the most overlooked strategy of all, consider whether a voluntary tax withholding election makes sense for you. You can fill out IRS Form W-4V and request that federal income taxes be withheld directly from your Social Security benefit at a rate of 7, 10, 12, or 22%. For retirees who are paying quarterly estimated taxes on their benefits, this simplifies the process and eliminates the risk of underpayment penalties. It also forces an honest accounting of how much your after-tax Social Security income actually is, which is the number that should be driving your budget, not the gross figure. Now pull these pieces together and see what the picture actually looks like. If your gross Social Security benefit is $2,100 per month and Medicare Part B takes $185 and you elect 10% federal withholding on the remainder, your net monthly deposit is approximately $1,126. That is a difference of $374 per month from the gross figure, or nearly $4,500 per year. If your retirement budget was built around $2,100 and you are actually receiving $1,626, and that gap accumulates fast. It erodes emergency funds. It forces early retirement account withdrawals that trigger more taxes. It creates a quiet financial stress that many retirees attribute to vague feelings of not having saved enough, when the real issue is that they are measuring their income against the wrong number. The retirees who navigate 2026 successfully are not necessarily the ones with the largest benefit amounts. They are the ones who understand exactly what is being deducted, why it is being deducted, and how the interaction between COLA increases, Medicare premiums, and federal tax rules affects their actual take-home payment. They are the ones who review their SSA statements before the new year rather than after. They are the ones who run their combined income numbers in October, not in April when it is too late to adjust. There is still time to be one of those people. Not because the system is going to get simpler. It is not. Not because Washington is going to close the loopholes that allow bracket creep to silently tax more and more retirees every year. They have not done it in 40 years, and there is little reason to expect change now. But because the information is available, the tools are accessible, and the calculation, once you actually sit down and run it, is entirely within reach for anyone who takes it seriously. Social Security was designed to be a foundational piece of retirement income, not the whole floor, but a reliable base. For it to function that way in your retirement, you have to engage with it actively. Check the numbers. Understand the deductions. Know your combined income threshold. Review your Medicare plan. Make the tax withholding decision deliberately rather than by default. These are not complicated moves. They are just the moves that most people keep putting off. And in 2026, the cost of putting them off is going to be higher than it has been in recent years. Because the next Social Security change on the horizon goes beyond COLA adjustments and Medicare premiums. It touches the long-term solvency projections of the trust fund itself and the potential policy responses that lawmakers are already beginning to debate behind closed doors. And very few retirees are factoring that into their planning at all.